Michael, hello. I know you're very busy. You must be much in demand with BBC and other radio stations wanting to get your view on obviously what's been happening recently. And obviously I know you've got other responsibilities in the city and elsewhere, so do appreciate you finding the time to come and talk to us again. Thank you very much. What can we say? We're living in very, very interesting times. I don't know whether you can recall a time of previous events that really bear comparison with what's been happening over the past couple of weeks or so.
I think it'd be very hard put to find anything that's comparable to the last 2 weeks in the UK.
Before we go on to talk about the economic issues arising from that, I know that our clients will have been concerned, and may still have some concern about the recent events and their effect upon their portfolios. So I've taken the precaution just to double check all the numbers before our discussion, and it's really quite interesting. In terms of the first half of the year, all of the portfolios are up in value, with the exception of the cautious portfolio, which is obviously the least risky, which is down 0.94% so far over the 6 months. And then since Brexit, which unbelievably was a fortnight ago, very, very recent, the picture is the same, with all the portfolios being up, apart from cautious, which is down 0.24%. So hopefully there is a reassuring message in terms of where we are. Obviously, what we really need to talk about is what happens going forward. Just as an aside, I can remember going to a presentation which Mrs. Thatcher did in Colchester a number of years ago, and after the dinner, when she stood up to speak, she said famously, "I'm only going to talk about 3 things: Europe, the economy, and the world." So I'm not going to set that as the full agenda, but some of the questions are going to be broadly in the same area. So I've got 3 questions. One obviously is Brexit. How and when is that going to affect the UK economy and markets? Secondly, volatility, because so far I think it's fair to say it's not been what we would have expected it to be. Mm-hmm. And then thirdly, emerging markets. Most of the comments about what's going to happen in the global economy to do with Brexit and elsewhere has really been focused on the established global economies and markets. So it's really understanding whether it's good or bad news as far as emerging markets are concerned.
Right.
Easy agenda. 3
easy questions. Let's start with the UK. The obvious response to Brexit is that economic growth will be lower for the next year or two than it otherwise would have been, and inflation will be higher because of what we've already seen in terms of the fall in the exchange rate. So it wasn't so surprising, with a deteriorating growth outlook and with higher inflation prospects, that the market's immediate reaction was to sell off quite aggressively. But then you got to valuation levels that people thought, well, actually, that's an aggressive sell-off. Maybe it isn't so bad. And certainly for the large cap companies, the FTSE 100, they suddenly started to look much more attractive. We nearly got to the stage where that index was producing a 5% dividend yield, which in a very low interest rate world was very attractive. So it's not so surprising that you started to see people take advantage of those low valuations and go in. I think for the medium term, the thing I focus on is not so much the downgrade to economic growth for the next year or two, because I think we may find that that is more of a relief than some of the fears we now have. The concern I have is that inflation might prove to be much more problematic than we are currently thinking about. In the last few years, we haven't thought of inflation as a particular problem. But this shock has come at a time when wages are already starting to go up, where you are starting to see higher food prices, where you've seen increase in taxes on insurance, and if you now see a further increase in imported goods right across the board, then there is a fear that we will see an inflation rate that is 3, 4, even possibly higher than that in a year or two's time. And that is going to be a dilemma, because the Bank of England has a 2% inflation target, and if it looks as if inflation is going to be well in excess of that for any length of time, they're going to have to start raising interest rates rather than giving a boost to the economy as they're now doing. So that is the medium-term dilemma that I see for the UK, and one that I think we need to bear in mind in our planning for portfolios.
But in terms of the Bank of England's stance on interest rates, if the economy does slow to a degree because of Brexit, then the government's already been talking about further easing in terms of the economic conditions, hasn't it?
It has, but conditions have already eased without any changes to interest rates, both by the fall in the exchange rate and also by the removal of the capital buffer on the commercial banks, which effectively allows them to lend much more than they otherwise would have been able to. So that potentially is a boost as well. So from the UK's perspective, I would say I worry less about the growth slowdown and more about the pickup of inflation. As far as the world is concerned, well, the world actually is the sum of many parts, unfortunately. And in the United States, because they've had a fairly lengthy recovery, it wouldn't be so surprising if they started to see a degree of slowdown going into 2017. To some degree, you've started to see an element of that, but it won't be worrying. And indeed, in the case of other parts of the world, like Japan and the Far East generally, where they are still able to reduce interest rates, they are still able to give a boost to their economies, and basically where the underlying growth rate is higher anyway, those areas I think will be relatively secure. One area which inevitably always causes us concerns is Europe. Partly because of the news from the UK is a shock to Europe as well, and some of the expectations for Europe have also been wound down. But you have got a series of very specific problems in Europe. At the moment, the Italian banks are a focal point, and they need a great deal of support. You've got many elections and referendum coming up through Europe, so the whole political vision might be threatened, and that obviously implies that there will have to be a higher risk premium to governments in Europe. And then finally, when we look at the bigger picture of emerging versus developed, well, the interesting thing this year has been that the emerging stock markets have really bounced back. If anything, they've been overshadowed by the developed markets in the last 2 or 3 years, but this year they really have come back. And there are 3 reasons for that. The first is that they were cheap, and indeed, if you look at the Asian markets, their valuation was the lowest relative to the rest of the world since 2003. So really looking very attractive. Secondly, the dollar stopped rising, and the dollar starting to fall means that you are pushing out liquidity to the rest of the world, and that's particularly important to the emerging area, many of whom have their currencies linked to the dollar. But thirdly, you started to see a bounce back in commodities, particularly the oil, because a lot of emerging markets clearly are very oil dependent in terms of exports. So all those 3 conditions together have given a reasonable bounce to emerging, which in the case of Asia, I think is likely to continue, because they are still looking relatively cheap, they still have got better economic fundamentals, and frankly I don't see the oil price actually flying to very high levels that would be disruptive to them. I think the new range for oil is somewhere between $30 to $60 a barrel. We're towards the top end of that range now, but certainly if we stay below 60, they won't be very adversely affected. So put all that together, and the emerging story I think does have more legs, particularly as I say, within the Asian community.
Could you just say 1 or 2 words about what you think, the things we've done in the recent past in terms of the portfolio, any adjustments in terms of asset allocation, and what sort of areas we would look at perhaps more closely going forward in terms of taking into account all the things you just referred to?
Well, I think the biggest thing for us to take note of, usually always, but particularly relevant this year, is the volatility of markets. And for many years, even with interest rates being quite low, markets weren't particularly volatile. They were pretty well correlated, they all moved together, and they weren't actually particularly volatile. That isn't the case this year. The volatility in virtually all the asset markets are between 1/3 to 1/2 higher than the average of recent years. So faced with much greater risk in portfolios, the importance of diversification really matters. And that's why we look at more than 12 asset classes to spread the risks across the spectrum, particularly for low risk, risk-averse investors, but equally for high-risk investors. In these conditions, diversifying your risk is really quite important. And so if you look at the Fiducia portfolios, the risk levels are much lower than those that you've seen in the stock markets generally.
And the challenge for us is to maintain that position.
That's right, it is. And the other thing which we featured in previous interviews is that if you look at the very long term, there are some companies coming through, large quality companies, that are going to be the winners of the future. And within a 5-10 year framework, the biggest 500 companies in the world, half of those will come from the emerging areas. So that's quite an important focus. So to have within our portfolios an exposure to large cap quality companies actually is much more important a decision to make than deciding between country X and country Y, because these are global companies that will be successful globally, and hence you want to ensure that you've gained access to those through the funds we buy in the portfolios.
So although, as you said, volatility is an issue, it certainly doesn't mean that we significantly move away from our interest in emerging markets. I'm sure the focus on individual markets will change, but broadly as a sector.
We've added to our exposure to emerging markets in the early part of this year, partly because we thought the valuations were attractive, but that has obviously paid off because of what's happened to the reform packages there. And if you look at some of the Indian reforms, some of the Indonesian reforms, the Philippine reforms, this isn't all about China and Japan. It's spreading out right across Asia, taking different forms, admittedly. But it's the sort of reform that allows shareholders to benefit, because it's a much more commercially friendly, corporately friendly environment for these companies to thrive in. And so we are trying to take advantage of that.
Thank you for all of that. Next time we meet, a new Prime Minister will be sort of well and truly installed, and who knows what other events may have happened. But anyway, thank you ever so much for your explanations and your time once again.
Thank you, John.
Thank you.